the Director of Industrials Equity Research at CFRA. He joins me from New York. No matter what GE does, the stock goes down, arguably with the exception of today. What's gone wrong?
Well, GE has had transformation after transformation, restructuring charge after charge, and there's been a lot of shoes to drop on the company. Every time they have an earnings call, they announce a new charge. Most recently, the $6.5 billion insurance write-off and a $15 billion reserve that they had to set up for future claims against a business that they haven't been in 20 years. So every time that investors start to think that maybe the stock has bottomed out and things are going to start to improve, there seems to be another charge, and that's what's gotten in the way of the stock.
All right, but if we look at the core businesses of GE, now they've got rid of so many of them, but it's now medical services, it's these sort of high-tech type of stuff. They've moved to research, they've moved their headquarters. Is the firm fundamentally solid on its product base?
We think that they are the leader in many of its business segments, like you mentioned, aerospace. They're great in oil and gas. They're great in medical. They have very good technological advantages in a lot of businesses that they operate in. But the problem is the balance sheet is at risk. These charges that keep happening make investors very wary. And there has to be some issue as to what kind of valuation do you attach to a stock that hasn't risen earnings in a generation.
Okay, in that situation, are we, and I know that the new CEO has said that a full review of the portfolio is warranted. Do you see the breakup value being greater than the sum of the parts?
No, it's our view that the company is more valuable as a conglomerate, that these pieces do share common R&D, common sourcing of materials, and common customers that you may not expect, that does allow it to generate synergies from being together that would not be there if they were apart. But also, if you broke up the company, it's important to note that the capital division, the financial services arm of the company, a lot of debt that is attached to that division would go to the individual units, making those units less valuable than they appear to be.
Right, but if you're right, sir, then eventually the balance sheet woes of the capital and then the insurance losses will dwindle out, and the company does have a strong, sustainable, profitable business. But we're just not seeing any evidence of that.
Well, Wall Street is very, very impatient, right? So the new CEO, John Flannery, came into place in August. In November, he announced his latest restructuring action. These things take some time to work. So he's the new CEO. He needs a little bit of time to do it. So we need to see a year or so. Wall Street is interested in the next quarter, the next day. They keep starting and stopping the stock, and obviously, as things don't come to fruition, the stock goes lower each time. So we need to see 1 to 2 quarters of the company hitting targets, meeting expectations, and then the stock can move from there.
The rumor today was that Warren Buffett's taking a stake, and that's what took it up 6%. The other story, of course, is that if it carries on like this, the ratio of the stock price to the rest of the Dow components means it gets kicked out of the Dow. So take either of those two rumors. Which one do you like and which one don't you? Warren Buffett or kicked out the Dow?
Yeah, first of all, I would be very surprised if Warren Buffett wants to wade into the complexity that is GE. I could certainly see him being interested in buying one of the assets. GE has many fine divisions that's running profitably. If GE is interested in divesting, I think Buffett would be a big player there. But to buy the entire company, I think that's a false rumor. In terms of being kicked out of the Dow, I think that's more likely.
Good to see you, sir. Thank you for joining us. I appreciate it. Thank you.
Thank you.